All right, let's go ahead and get started. Good afternoon once again, and welcome to the first Fast Track of the year. My name is Peter Benjamin, and today's session is going to be awesome. We have a new friend of ACUMA joining us today who will impart a great amount of wisdom when it comes to portfolio pricing strategies. Before we dive in, just a few housekeeping items just to go over. This session is being recorded and we post to our website at a later date. I will be monitoring the chat on my other screen. Feel free to ask questions and I'll do my best to weave them in. And I guess finally, we have a lot of great things happening this year and we couldn't be more excited for our first in-person event happening in Dallas, March 21st and 22nd. Registration is open. I promise this is going to be an event that you're not going to want to miss. And finally, a quick disclaimer. The views and opinions expressed during this webinar do not necessarily reflect the views or positions of ACUMA, its board of directors, its management staff, or its members. The webinar and its materials are presented as a set of ideas and possible strategies regarding its specific topic and does not represent any endorsements of either the presenter, their firms, or the concepts they present. I think that's it for today. So I guess let's get on with the show. Today's ACUMA webinar is being brought to you by Member First Mortgage. Joining us today is Linda Clampett, Executive Vice President of Credit Union Sales and Production. Linda, welcome.
Thank you. Thank you for having us, and we're looking forward to hearing you and Russ today.
Thank you very much for that. Thank you. Linda, I have a few questions for you. But before I get to them, I want to say, in addition to supporting or sponsoring today's session, we are, which we're really grateful for. Member First Mortgage has been a long supporter of ACUMA, our members and really the credit union movement. And for that, thank you very much. And really, as I segue to the handful of questions I have for you, although Member First Mortgage has been a member of ACUMA for quite some time, there may be some credit unions that are not familiar with Member First Mortgage. So if you could, give us a high-level overview of Member First Mortgage and really, what makes your mortgage QSO so unique?
Sure. Happy to do that. We're a QSO that specializes in origination and servicing solutions for credit unions. Mm-hmm. We're approved seller servicer for Fannie, Freddie, FHA, VA, obviously several credit unions. We work with about 300 credit unions throughout the nation. One of the things I think makes us unique is we have a variety of partnership levels, I think 8 different levels. So we do a lot of customization where the credit union can set their own revenue marks, their own pricing, their own closing costs, and we'll allow the credit unions to use our system. So if they're not ready to invest in a complete LOS, it gives them an ability to get in at a good price point and start offering mortgages and use our system. So
I love it. So this next question's really on topic. Again, portfolio pricing strategies. So what trends have you seen with credit union portfolio lending really over the past 6 months? I mean, we could easily have this conversation about the past handful of years, but let's focus on the last 6 months.
Yeah. It's changed a lot.
It has.
Liquidity has certainly changed for credit
maybe
unions.
Maybe a little.
Last spring, I think everybody wanted to portfolio everything and then some. And now, so the big trend we've seen is credit unions stopping or slowing down their portfolio lending and selling much more into secondary through either a QSO or directly. So that's been a big trend. We've seen a big trend go to ARM loans. Okay. As rates have gone up. So a lot of hybrid loans and a lot of specialty products. So credit unions really reserving their portfolio to really make a difference and stick out in their region that they are covering. So that could be like, we have some that are doing I-10 programs. We have some that are doing 100% financing, some one-time closed construction. So a lot of specialty products. And a lot of the MI companies support those specialty products and will insure those. So we work with a lot of the MI companies to do that. So those are really some trends that we see happening since we've entered the higher rate market and a purchase market.
So I want to stick on the portfolio product theme because I know this will come up in conversation with our subject matter expert today. From your view, what portfolio products have been the most successful with your partner credit unions since since rates have gone up and we're in this purchase market?
Hybrid loans have been very successful. The most successful have been a 10-10 ARM or a 15-15, where it's amortized.
I love a good 15-15. I do love a good 15.
It's not near as scary for the member because it's not changing so often. So we've had some credit unions that partner with us that both of those products have been very well received by their membership. I would say the 5-6, 7-6, 10-6 SOFR ARMs have been very successful. I-10 loans have been really, I was surprised. I didn't know how successful that would be when a couple of our credit unions asked to do those. And those have been well received. I think you have to be in a specific market maybe for those to be successful. And then we started an IMPP program this year, which is where we partner with independent mortgage companies. A lot of these are builder companies and they're looking for well-priced ARMs and there aren't any in the secondary. So we've reached out to credit unions to see if they want to purchase loans from these credit unions, and we work in a tri-party agreement. And so the credit union not only gets a loan out of the deal, they get a new member out of the deal because the borrower has to qualify for membership. So that's been very successful as well and well received. So those would be some examples that I would give you from the member first side.
That's awesome. Like I said, I love a good 15-15 ARM. Back when I was on the lending side, that was the dream product I wanted to put together. Which I never got around to it. I started this job, which I'm thankful for. So, anyways, Linda, thank you for your time. I truly appreciate you being here, your support of ACUMA and our members, and of course, sponsoring today's session.
We're looking forward to having you in Plano next month or in a month and a half.
Love Plano. Love Plano. We'll see you, Linda.
Thank you.
Thank you. As I mentioned, today's session focuses on pricing strategies for our portfolio mortgage loans. Today's speaker is a bona fide expert in all things secondary. It's my pleasure to welcome Russ Brady, owner of Blue Loans LLC, and the mastermind behind Blue Loans Secondary Manager platform, which offers a white glove approach to secondary routines and practices. Russ, welcome.
Peter, thank you so much for having me. Very excited to be here. Very excited to talk about this topic with you. It's a great topic. I think we've got a great group of attendees, and it's always interesting to talk about, well, what can we put in portfolio and how we're going to do that. So very excited to be here. Thank you so much for having me.
Of course. I'm kind of ad-libbing this part now. Although you are an owner of the current owner of Blue Loans, or you founded Blue Loans, you also have some credit union experience, which was one of the reasons why I was so interested in talking to you and having you on our first fast track of the year, was because you can speak from a credit union because you worked for a credit union, you understand credit union, you've been through it, and so thank you for your knowledge that you're about to share. But let's really start focusing on today. So Russ, there's a lot to talk about. Especially as we think about the past couple of years with interest rates going from points below 3 in 2020 and 2021 to cresting over 7 in 2022. Here we are in 2023 with rates starting the year off being comfortable in the 6s. Actually, this is not an exaggeration. 15 minutes before we started this webinar, I got an email to my personal email account, someone advertising jumbo loans in the 5s. We all know that rates fluctuate, but we all know that, right? And we always have to keep in mind, these questions. Is it the right time to portfolio? Should I sell? And I guess, regardless of the answer to that question of portfolio or sell, there's really an art to both, right? I think you can agree with that. There has to be an art to answering both those questions. One thing is for certain though, is that if the answer to the question leads you always to the portfolio, then there's some risk associated with that. Am I right with that?
Absolutely. I completely agree with that. That there are risks to portfolio lending, and whether it's the interest rate risk or the credit risk, the risk of default on those loans, it's not a slam dunk. So there are certainly advantages to it. There's some disadvantages to it, just as there's advantages to selling or not selling loans.
Okay, so let's break down that a bit. Now let's talk strategy and things to consider. Last week, you and I sat down and put together a rather long list of, it's a good list. I personally think it's a great list, but we put together a list of some important thoughts and talking points that we want to kind of express to people listening in. And rather than having a series of questions, let's just go through the list and discuss each item. So let's start from the top. First up, let's discuss the need for just an overarching portfolio strategy. Let's just talk about that. Let's talk through the need to have that strategy.
Absolutely. You definitely want to think about it strategically, just as you're saying, right? So the portfolio lending is a big advantage for credit unions compared to a lot of the mortgage originators, to the independent mortgage bankers, right? Because a lot of them do not have a portfolio. They can't put these loans into portfolios. So everything that they have to originate, they're looking to sell on the secondary market. So having that ability to put these loans into portfolio is a huge advantage, and you want to think about that strategically, right? So we have to figure out, what is the goal of that portfolio? Are we looking to grow it? Are we looking to shrink our portfolio, or just simply maintain that portfolio? So that's working a lot, the lending side of the house, working in conjunction with the finance side of the house, taking a look at that balance sheet and coming up with a strategy on what should that look like, and do we want to grow? Do we want to, how do we want to think about that portfolio?
Okay, so let's talk about, let's pretend like your goal is to shrink that mortgage portfolio. Let's walk through that. What is that strategy to kind of shrink that portfolio? There's a lot of things you can do actually to shrink your portfolio, right? Well, what are some of those things? What are some of those things?
Yeah, a couple things to think about. Well, you can always sell loans out of your portfolio, even if they're aged. That's not my favorite way to do it. I'd rather think about, how are we going to direct new production? Are we going to put that into the portfolio, or are we going to sell it? So the portfolio is going to have a natural runoff, right? Probably within 4 to 7 years, the majority of the loans that you have are going to pay off. And so we want to think about, well, what do we want to do with that new production? Do we want to put that into portfolio, or do we want to sell it? So if the goal is to contract it, and you're thinking about that, your CFO, we're thinking about that in terms of, well, other assets that we could put on there. So we've got to balance, auto lending and commercial lending and other things that we have to think about. And so once you get that balance, and if that leads you to, hey, we want to shrink that portfolio, I really like the idea of new originations being sold on the secondary market and letting that portfolio run off. But of course, you could go through your portfolio and look for loans to sell, which, in this environment, is going to be very difficult. You're going to be selling at a loss, just where the rates are for the most part.
All right, so grow, reduce, maintain. If you just have a plain vanilla portfolio, and I guess is the best thing to maintain it. Are you looking to or do you want to double down and try to grow that portfolio? Like what is? I guess that's really. Let me rephrase that question, if you don't mind. As we look at our balance sheets, right, over the past handful of years, we'll say between 2020 and 2021, and in the first quarter of 2022, we are all-time low interest rates, right? Some interest rates below 3.
Right.
It's not a good idea to portfolio them. If we had to, we did, then that's fine. But is there a benchmark, would you say, where it just makes sense to portfolio versus selling it off when it comes to interest rates?
Well, when it comes to interest rates, it really is going to be specific to each individual situation about whether they want to put, it's kind of a loan to share ratio, taking a look at that. Do they want to grow the balance sheet or not? But certainly when rates go below 4%, I would think just a general rule of thumb is around the 4% level is where mortgages will kind of gravitate to. Somewhere in that area. And when they're really low, when they get below that, and certainly below 3%, those loans that you put in portfolio are going to stay on the books for a very long time, likely.
Yeah.
So you've got to be aware of that and concerned about that. It's not in that refi environment, not a very good environment to put, jumbo 30-year fixed on the books.
Agreed. So let's pivot. Let's go to products. This is a question that I asked Linda, in the beginning. What products are you, from your viewpoint, what products are the best ones to include in your portfolio pricing strategy? How can we design products that set us up for success in the future? Give us some insight into just overall products, maybe product development, product types. Let's go from there.
Sure. I loved what Linda said about the products, especially the hybrid ARMs.
Sure.
They're a great portfolio product.
Do me a favor. Let's take a step back. Define hybrid ARM for us.
Okay, excellent. Thank you. So a hybrid ARM is an ARM that has a fixed rate component and an ARM component, and that's why they're called hybrids. So they've got they look a little bit like a fixed, but they also have some adjustable rates attached to it. So the most popular ones are the 7/1 ARM would be fixed for the first 7 years and then adjust every year after that. The 10/1 ARM would be fixed for the first 10 years and then adjust every year after that. And so that's typically the most popular ARM products. But just as you were, as you and Linda were discussing, there's a lot of other, you can structure it a lot of different ways, the 15/15 and other types of products. But they're great portfolio products. And the reason is because, for one, the hybrid ARMs do not trade well on the secondary market. So there's not a good outlet to actually sell these loans at attractive rates. And so it gives again the credit union the advantage over some of the independent mortgage bankers who do not have that portfolio, because they can offer this product at a more attractive rate than if you didn't have a portfolio.
Okay.
So that's one great advantage. And then certainly the other advantage is the interest rate risk profile of that loans, comparing that profile of that loan to the balance sheet and to the funding sources and things like that. It's a much better match from a cash management, interest rate risk management perspective for the finance side of the house.
Just want to confirm, a 4% interest rate on an ARM is better to put on the portfolio than a 4% interest rate on a fix, correct?
Yeah, I would think so.
Okay.
Certainly. I think just in
from
general,
an interest rate risk standpoint.
From an interest rate risk standpoint, I think any adjustable rate is typically better, as long as it's going to adjust up, to, you'll have a spread above that index on where that rate is going to adjust to. But in general, yes, the ARMs are a much better product on the portfolio than the fix.
Okay. What about like some specialty products?
Yeah. So the other products that I think work really well in a portfolio besides the hybrid ARMs are going to be products that are non-conforming, not eligible to sell to Fannie Mae and Freddie Mac. Okay. So there are little niche products that can be carved out that make them not saleable to Fannie and Freddie. But because we can use our portfolios to originate those products, that's really where we can focus on generating interesting products that that will get a lot of nice buzz out in the in the real estate community for the realtors and things like that, and to develop relationships that way. But some of those products, that are typical are non-warrantable condos.
Yep.
That's a big one.
Oh, yeah.
And this is typically in areas that are growing. where you see a lot of new where you see population growth and the communities are growing. And then we see the condos go up. And then the condos, as they're going up, they're not warrantable. We can't sell those to Fannie Mae and Freddie Mac because the project has not yet gained sufficient points in development to be sellable to Fannie and Freddie.
Yeah, and the interesting part of that, depending on the condo development, depending on the number of phases, depending on the size, right?
Yes.
I mean, this could take years
Yes.
from the time that we'll say a potential homeowner or we'll say a home buyer is ready to buy and ready to sign to the point where that project becomes warrantable could be years.
Correct.
Right? So I guess that's a strong case. That's a strong argument to have that in your toolbox, right?
Absolutely, absolutely. And again, and that helps generate a lot of referral source, get you in with some referral sources by saying, hey, we can lend in that new development that's going in and others cannot because they're non-warrantable at this point. Now, I'd be, again, this is a little bit more risky. So you have to be paid for that risk of allowing non-warrantable. It should be above the conforming rate that you're offering. And also I would caution too, in that particular product, I would set a limit on how much exposure you can have to one particular development. That would be a way to limit the risk of that development not being finished. The builder goes into bankruptcy or something, and you're stuck with this non-warrantable condo in a development that's really struggling. So, I'd put some guidelines around that to limit your risk in those particular projects.
Okay. So there's other specialty products that we can focus on, right? I mean, I have one in mind, and we hear about it a lot. The doctor's program, or we'll call it professionals program. What are your thoughts on that?
Yeah, I think this is a very popular program too for portfolio, where it's looking at certain allowing that certain professionals, maybe just getting out of school, like a doctor has just received their license and now they're eligible to go out and practice, and maybe they don't have the credit history, or they may have a great deal of debt for all of that schooling,
Sure.
and their DTIs may need to be a little bit higher, above the, typically above 50%, that you start getting into ranges where the automated underwriting systems on the conforming side are going to shut it down and say, no, that this is not eligible. But you may look at that from an underwriting standpoint and say, hey, this actually makes sense to me. We expect the income to be very strong and there's a lot of demand in this. We don't think that there's going to be an income issue in the future, so we can get around these DTI requirements.
Right. And I agree that professional type programs are valuable to put to have on you, again, having your toolbox. They're good loans put on your books. But let's pivot to a loan product that is near and dear to my heart, something that supports first-time home buyers that may not be in that professional level, that may not be a doctor. What about those types of loans, or those good loans that kind of keep in our strategy as well?
Absolutely. I think there are some programs out there, some portfolio lending programs that are 100% LTV, where if you're getting a conforming, it's typically at least 5%, but they do have 3% down options, and the FHA, we're looking at 3.5%, and all of these things. So so that 100% program is a terrific program. And just like you said, it really just fits into the mission of the credit unions of how do we help people. And that is a terrific program again, but it's something that carries a lot of risk, right? Because
Sure.
Housing prices, we've seen it just recently in the last 6 months. Housing prices have come down. Of course, they went up tremendously, but they've come down. So if you lent to somebody on a 100% LTV program 6 months ago, they may be underwater at this point, right? Their loan may be more worth, may have a higher outstanding balance than what that house is worth at this point. So it's a very tricky program in some ways, and it's probably very market specific. So really understanding your specific footprint and what that market, are you seeing in general price appreciation and demand for housing and those types of things. So I don't think it's for every single market. The other thing about that program is that we've got to consider in all of these portfolio programs, we've got to consider, well, what are the other programs that are similar, and how is it going to compete against these other programs? Because the best rates are going to be the conforming rates. And so compare that program to, well, what's the conforming rate that could be obtained on this through Fannie and Freddie? And that's typically, this program would be compared to the Home Ready and Home Possible programs by Fannie and Freddie, which are 3% down programs. They're getting rid of the loan level price adjusters on these, right? So they're very low rates in that product. So if you're looking at the 100% LTV, you're not getting above conforming rates on these loans, coming into portfolio. In order to be competitive, it's got to be, very similar to the conforming rate.
And there are ways to get to 100% without actually originating 100% loan. Maybe there's bonds or down payment assistance programs. I mean,
definitely
just even having a list of those that you can work with is part of it, right? And possibly even reduce that risk on your portfolio. Right? Am I on the right path?
You're absolutely right. I think your operations department will say, hey, these programs are very difficult to navigate and get completed. And I think the loan officers, I think the entire mortgage department would feel the same way. That this is great. In our state, we have this bond program, but typically, unless you do a lot of them, it gets, the more you do, the easier it gets because everyone gets used to it. But if you're just doing a few here and there, it can be, those programs can be problematic to originate.
Agreed. And I've worked for organizations where I've developed those programs and gone through the trainings with the local bond agencies. I mean, you really need experts who understand and originate them quite often. Otherwise, you're just going to put loans on your books that are high risk because they weren't originated correctly. And that right there is really the opposite of what we're trying to accomplish with today's webinar, right? Where we don't want to do high risk loans. But if you know someone who understands them and who pays attention during that training and has a good understanding that it takes time to originate those loans, they could be fantastic.
I completely agree. They can be fantastic loans.
So let's pivot to, I guess, the next item on our list, pro forma. Let's talk about that.
Sure. Yeah. So once we kind of get our arms around what kind of product we want, the next step is typically developing some sort of pro forma for that product. And that simply means, what is the return on investment that we're expecting from this? So again, we kind of go, but let's think about the finance side of the house. The chief financial officer. We're looking at these different products that we have available, whether it's mortgage loans or car loans or other business lending, all of these different types of things that we could be doing. And we want to make sure for the membership that we're using that money wisely and getting an appropriate return. And so that pro forma process really maps that out. Of what do we expect the returns to be on this product. And so in order to get there, usually what we're talking about is looking at what our cost of funds are. How are we going to fund this? How much does it cost us to originate that loan in terms of how much that money costs us, the funds that we're providing. What is our cost of funds? And the finance side of the house is going to have a good handle on that, what that cost is. But then you have to layer in the performance of that loan. What are the expected losses on that loan? And if you think it's zero, then that's probably not the right number, right? There is some number that you should be considering, even as home prices are appreciating in your area and things like that. There are risks associated with a lot of these loans. And I would suggest looking at your historical loss rates. Hopefully you have something in portfolio. Take a look at historical loss rates in similar products and make sure that you're looking at those loss rates in different economic environments. What does it look like we've had a lot of very long runs of a strong economy. But what happens during those downturns? What does that loss rate and delinquency rates look like? So understanding, so coming up with an expected loss, that's a project in itself.
Sure is.
Trying to figure that out. There's a lot of tools, a lot of different ways to do it, but one of the easiest ways and the less expensive ways is take a look at your own portfolio, look at the delinquency rates, foreclosure rates of your own portfolio, and make sure that you're looking at that in different environments, not just during the economic boom times.
Agreed. So, another thing we can do is really just as we're going out, we'll say, jump out the gate with this program is really establish that threshold of, we're going to originate X number of loans the first year, see how this performs, and then maybe the next year increase that amount, right?
Yeah.
Some bond programs do that, right? They tend to have a budgeted amount, or some agencies like the Federal Home Loan Bank System, for their programs, their down payment system programs, they tend to have an annual amount that they can lend out, and it's perfectly okay for you to do that as well with this with your portfolio products, right?
I love that idea, Peter. I think that's great. Is to think about, well, what's the sort of limit that we're willing to put of this loan on the portfolio? Because, and especially if it's a new product and you're not 100% sure of the risk and the delinquency rates that you're expecting and all of those types of things.
Prepay speeds, right?
Yes, prepayment speeds. We don't know exactly how they're going to perform. I do like that idea of, it gives you a little bit more control around this whole process. We can put limits around that.
Okay. So let's move on to the next topic that we want to discuss, just the pricing strategy. So we talked about portfolio strategy, we talked about products, we talked about pro forma. Let's talk about the pricing strategy recommendations. As we looked up, put some of these great loans that you recommended or suggested as being that should be part of your portfolio strategy. Part of it is how do we price these loans? So let's talk about that.
Yeah, so pricing portfolio loans can be very difficult. There's a whole bunch of, there's a few factors that we need to consider on how are we going to price this loan. So I think at first, the first step is really thinking about, well, what is the rate that we need to offer here? And compare that to a similar conforming product is the best way to look at that. What is the conforming rate out there? Certainly understanding where is your conforming 30-year fixed rate, yep, and where does this rate need to be? So we can benchmark that initial rate that's being offered to that conforming rate. We could benchmark it to a 10-year treasury rate, but always keep in mind, where is that conforming 30? Because that's going to, most of your volume is going to come in that product, and understanding where that rate falls is really important. Trying to figure out where that rate, that initial offer rate, is going to be is a big step.
But correct me if I'm wrong, this is where your research of the market for similar products comes in handy as well, right?
Yeah.
You don't want to, especially when it comes to a specialty product, you don't want to buy the market. You don't want to be so far outside the market that you're not able to originate these loans. Right. Is there a sweet spot that from, we'll say, the leader to being so far removed, is there a sweet spot that you want to be in when it comes to thinking about these products?
Absolutely. So on the hybrid ARMs, I would recommend that they always have to start below the conforming 30-year fixed rate, right? Unless there's some guidelines in that adjustable rate mortgage and that hybrid ARM that is non-conforming, where you feel like there's additional risk to it, then that rate could be above the conforming rate. But if what you have is simply kind of a conforming program that's a hybrid ARM, then that rate has to start below that 30-year, or you simply just won't get any volume in that product, right? So for the hybrid ARMs that are conforming, they should start below that conforming rate. And I would suggest probably at least an eighth or a quarter. I think a quarter is more comfortable on a 7/1 ARM. So if today's rate is 6% on a 30-year fixed, that 7/1 ARM probably should start at 5.75%. So that's how I would think about the hybrid ARMs.
I mean, and I know you're not a loan officer, but I mean, in my opinion, a loan officer should be able to sell that quarter difference, right?
Absolutely.
Especially in today's market. 7 years is a long time, right? That is no matter how you mix it up, a lot can happen in 7 years when it comes to our market. I mean, let's just look at the past 3 years. What has happened? Even before that, when you look at 2019, what the average interest rate in 2019 was, 3.45. If I think off the top of my head, was the average interest rate in
Right.
2019. In 2018, I think it was around 4%, four and a
I
quarter
think it was in
maybe.
the fours. Yeah.
So I mean, those aren't bad interest rates, but a lot can
No.
happen. The market can move, especially over 7 years. So I mean, you should be able to. I mean, that's a long time, right? It's a quarter you can easily sell. Anything else? Anything else when you thinking about that pricing strategy that would be a good takeaway for the people watching?
Well, so for the hybrid arms, I think they have to start below the conforming. Now, these
Right.
other niche products, where you've expanded the credit box and you're allowing product that cannot be sold to the agencies, to Fannie and Freddie, that rate should be above there, because those are more risky, and
Sure.
the credit union should be compensated for that. And you don't need those to start below the conforming rate. So that I would worry about those, about what the starting rate is. I try to drill in on where do I need to have my initial rate. Okay. And then it gets much more complicated, because the next step becomes more complicated. And that is, how are we going to adjust that rate based on the risk characteristics of the loan? So
Right.
if
The
we
loan
think
level
about,
pricing adjustments.
yeah, exactly. So if we think about those conforming space, we got that LTV FICO adjuster on the 30-year fixed,
Mhm.
right? So along those lines, how are we going to adjust the rate? But
Sure.
portfolio products are a special animal, because in the conforming space, we have different prices for different note rates that's easily available. If we're selling them to Fannie and Freddie, we can get the pricing at different note rates, and we can understand how those price adjusters change that rate by taking a higher rate and paying for the loan level price adjusters. Well, in a portfolio product, we may not have that, right? We may not have different prices at other rates. We may simply say, I want my 7/1 ARM to start out at 5.75%.
Sure.
So what I recommend for true portfolio products is to use rate adjusters to adjust for credit characteristics. So for example, if you take a 7/1 ARM, you can say for FICOs below 680, we're going to charge an eighth, or we're going to charge a quarter, or something like that in a rate adjuster. Okay. Same thing. You could maybe reduce the rate for FICOs above 780 or something like that. If you don't do that, then you've got to, if you weren't using rate adjusters, you would have to come up with what we would call a note rate stack, where we have all of these rates and have different prices, and then you're applying these price adjusters to that note rate stack. And it's kind of to me, it's a kind of useless exercise, when all we're trying to really do is make the rate higher for higher risk characteristics. So I would recommend for portfolio products to use rate adjusters, and not worry about building out this note rate stack.
Okay. Good. I'm happy you said, rate adjusters and basing it off the credit profile. All I heard was, Peter, you were right all those years. You were doing product development. So thank you very much for confirming that I was doing it the right way. So I appreciate that. So thank you. So last point, I'm watching the clock, but last point, let's talk about the product volume, right? Let's talk about the portfolio volume that you're putting on your books. Let's talk about that. Like, provide some feedback. How do we provide feedback to the stakeholders about this?
Sure. I think we need to keep track of, certainly when a new product rolls out, we need to keep track of that product. That should be some sort of special alert from the lock desk. If you have a lock desk or whatever your situation is, somebody should be monitoring that for, hey, we've got a new loan cross the line in this new program, or we got it locked, at least we got it in the pipeline. And monitor that certainly for the first month, to let all the stakeholders know what kind of volume we're seeing in this product. So if it's coming in, if we're locking it too quickly, maybe we want to rethink what the starting rate is. If it, if we feel like, hold on, we weren't expecting that, we can throttle, we can push that rate up and try to throttle back some of that volume. But I think certainly volume monitoring is very important when you're rolling out a new product. The other point I wanted to make around this is that this whole product development and decision making, are we going to portfolio it and what product it's going to be? I mean, this is a lot of work on your teams across multiple teams of the origination side and finance.
Oh yeah, could take months.
And yeah, so you've got to price it. You've got to set that rate where it's going to be, where you can generate some volume. If you're just creating a product and the rate is not going to bring in that volume, then you've really spent a lot of time on something with very little return.
Oh yeah. All right, Russ, we are approaching time, and you've given us a lot of excellent ideas, some good strategies. You've confirmed that I was doing it right all along. So I appreciate that. Yeah. But it's now time to wrap up. Before we do, any final words?
No, I would say I love that credit unions can reach out to each other to get good ideas about what are you doing here. I've seen stuff about product development exchange between credit unions for a number of years. I think that's fantastic. I also just want to mention, ACUMA has great resources for you as well. Reach out if you get stuck. There are certainly resources to help you. And if you reach out, I'm sure you can get some help in that area.
Well, Russ, I appreciate that plug for ACUMA. I've been watching our community page really a lot lately since we redesigned it right before Christmas. And, a lot of things that you brought up today have been questions asked in the community page. And I'm absolutely blown away by the number of credit unions who are jumping in and providing valuable feedback to others. So I couldn't agree with all your statements, especially the ones about how ACUMA has valuable resources. So thank you for that.
Definitely.
Well, Russ, let me go ahead and close out. So thanks again to Member First Mortgage for sponsoring today's webinar, and to Russ, thank you for your valuable insight. And to all of you, thank you for attending today's webinar. Your time is valuable, and we appreciate you spending the better part of, I guess, an hour with us today. We hope you enjoyed today's session. And finally, don't forget to check out ACUMA.org and our community for all the latest updates on our in-person events. Everyone, have a great day. We'll see you next time. Bye.